is an industrial REIT. We acquire, own, and operate industrial real estate in 6 markets: Seattle, San Francisco, LA, New York, New Jersey, Washington, D.C., and Miami. We believe these 6 markets are the best in the country, with both excellent demand drivers, limited new supply to geographic or political constraints. In fact, our portfolio is most closely located to the population versus any of our peers. We target traditional warehouse distribution facilities, improved land, which is land that is fully paved, fenced and lit, transshipment facilities, and a small amount of flex and R&D facilities. We target the best, most functional assets in each of these submarkets that are functional with appropriate truck courts, clear heights, ingress, egress, access to freeways, and importantly have the broadest and deepest tenant demand in each submarket. We went public in 2010, so we're now approaching 15 years as a public company, which personally and professionally has been immensely gratifying. We actually went public as a blind pool, and at the time of the IPO, we owned 0 real estate assets. So this is a management team that's acquired or built 100% of everything we own. And if I back up for just a second, the senior 4 members of management were originally at a company called A&B, which is now Prologis. And at our time at A&B, we ultimately operated in 15 plus countries, 50 plus markets, had joint ventures, co-investment vehicles, open-end funds. We built a development team. And what we've done at Terreno is take all of those learnings and boil that historical business strategy down to what you see today. We only own assets in these 6 markets, and our view and our goal is to outperform our real estate peers across cycles. We don't do any joint ventures, no complicated structures, no greenfield developments, and we have the best balance sheet in the business. We focus at Terreno on secular changes versus cyclical changes. It's tough to know when you're in the middle of a secular change until afterwards, but there are a couple of things that we're seeing today. The first would be e-commerce. That's been a tailwind for the last 10 years. E-commerce sales continue to grow faster than traditional retail sales, and we think that that's going to continue to be a tailwind for our business for the next number of years. I think the second area is an area that we're experiencing today where the point of production, meaning the point of manufacturing, may be changing. If that point of manufacturing is moving from China to other Asian countries, there's probably no impact to the supply chain. But if it moves to Mexico or India, that supply chain will need to adjust. Now, our portfolio is in the most densely populated locations, so we should be fairly insulated from some of these changes. But it's something we think about and analyze all the time from where do we want to own, which submarkets do we want to own perspective. I actually think we sleep pretty well at night. We have the lowest leverage of our peers and a deep and talented team. But we do worry about new supply, meaning the building of new warehouses. And at the peak, the last couple of years, we saw probably more than 650 million square feet nationally under development, when the long-term trend is closer to call it 200 to 225 million square feet. The construction pipeline has decreased dramatically from the peak, but it's still above trend from the last 20, 30 years. Now, our markets have very little new development, but the world's a continuum. And if a new nearby market has too much supply, then the adjoining markets can be impacted from a market rent growth. And our business is focused on outperformance, so we are constantly looking at our submarkets for potential weaknesses from new supply. We think we have the best governance in the REIT industry. We're tied for number 1. We continue to be tied for number 1 as ranked by Green Street Advisors. We have the most aligned investor compensation program versus our peers. Senior management does not get paid a significant portion of our comp unless we outperform either our REIT peers or our industrial peers. If we don't beat either index, that bonus is a 0. And I think the other thing is from a quality perspective, assets perspective, quality portfolio, it's difficult for an investor to see the differences in the short or even medium term. So what we do that is entirely unique in the REIT industry is we publish the unleveraged IRR of each asset we sell. And we've sold about 10% of what we acquire. So an investor can truly see how we've invested over the life cycle of each asset.